Treasury is ticking slightly lower ahead of the Fed's release of its January meeting minutes. Investors are hoping for more hints about the trajectory of interest rate cuts. The recent hotter than expected inflation report seemed to be convincing traders that the central bank could cut rates in June, according to the CME Fed Watch tool. For more on the bond market's reaction to the looming Fed minutes, we're joined by Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Great to have you here with us. So, based on what we see in the minutes, where could we see the most movement in the bond landscape?
Yeah, hi, Brad. Thanks for having me on. Well, I think that the biggest move would probably come at the shorter end of the curve, because that's where the great uncertainty is. Will the Fed start cutting in May or June? Will they delay longer? How fast will they go? Those are all the questions that the market's dealing with. And we've had so much volatility in sort of the 1 to 3 year area of the curve. So I think that that'll continue to be the case until we get some really solid information. And frankly, I don't think the Fed is necessarily certain itself exactly where they plan to go. Our view is that they start to cut in May or June, go 25 basis points at the next 3 or 4 meetings and see how things go. But that is predicated on the idea that inflation continues to come down and the economy moderates its growth rate somewhat.
Kathy, obviously this is not going to be included within the minutes, but the 2 inflation prints that we got last week, do you see that at all changing the calculus or the timing here, or maybe making the Fed a little bit more nervous and likely to stay with this wait and see approach now for maybe longer than it had initially anticipated?
My guess is that those that were nervous before got a little more nervous with those numbers. Those that weren't nervous before probably are shrugging them off and saying, first of all, CPI, it's not the PCE that the Fed uses as its benchmark. And secondly, 1 month doesn't make a trend. So I think it really depends on who at the Fed you're talking about. And that leaves us in this limbo, because we know there are a couple of holdouts, there are a couple of members of the Fed who really want to delay this process and are not certain that it's time to cut rates anytime soon. But that's probably a pretty small number, 1 or 2. And then you have the rest who are saying, we think we're set, we're ready to go. We just need a little more information for confirmation. So I think it's a push-pull from here, but we do need some good numbers to kick off the process. But I do hope that when we get the minutes this afternoon, we'll get some information as to what the holdouts are holding out for.
Yeah, it's interesting, Kathy. We got some commentary, and we're getting some more this morning, but there has been disagreement just in terms of what that last mile is going to look like in terms of the fight to tame inflation, how difficult it is going to be. I guess, what is your expectation there in terms of ultimately getting to that 2%? We're likely far off from that, and the Fed is going to act most likely before we get to that 2% level. But what do you think that last mile of the fight to tame inflation is going to look like?
I haven't been in the camp that I've worried that the last mile is going to be so much more difficult than the previous miles. We've got momentum. We're hearing from businesses that pricing power has come down, that they're seeing, certainly in some areas of the consumer sector, they're seeing people dial back a bit in terms of purchases and resist some of the price increases. At the wholesale level, we're looking at commodity prices still low and coming down. So all the indications are that inflation will continue to moderate. We have the rent issue, that owner's equivalent rent issue that's in front of us still, or continuing to kind of support inflation when you read some of the indices. But we also know in real life that rents are coming down. So I'm not in the camp that worries too much about the last mile being the hardest. And I think that the question gets to be what will convince the Fed that it's time to start reducing rates, because real rates are very, very high right now. And if they sit still and inflation does moderate further, that's just pushing up those real rates even further and risking triggering some sort of negative reaction in the economy.
I mean, consumer confidence right now, based on the most recent reading, Kathy, we know still sits at a 2-year high on the index on views of the current conditions, plus some declining pessimism here. And particularly what Dana Peterson at the Conference Board had mentioned was the increase in consumer confidence reflecting slower inflation and anticipation of lower rates ahead. How does the Fed ensure that with a confidence print like this, an environment, that they don't see a spike the second they begin cutting rates because the consumer is already anticipating it so much?
Well, so consumers are anticipating lower inflation and continuing to keep their jobs. Consumer sentiment usually is pretty strong, particularly the coincident indicators when people have jobs, and people have jobs. And that's why spending has held up reasonably well. So I don't think the Fed needs to worry about a spike in activity just because they cut rates. They might see the housing market pick up, which would be welcome, I think, after the long sort of slow frozen period that we've had. But I don't think unless we're starting to see wage growth just spike higher because of a shortage of workers, I doubt that the Fed's going to worry that this is going to trigger a big inflationary reaction.
Certainly. And then just lastly, for investors here, to round out this conversation, Kathy, if we do see less cuts than anticipated over the course of this year, is there a massive repositioning that some fixed income portfolios out there should be considering?
At this stage of the game, the market is priced for about 4 rate cuts of 25 basis points each between now and the end of the year. We think that's a pretty reasonable expectation. If we only get 2, then we're going to see quite a bit of volatility probably at the short end and a more of an inversion of the yield curve, because the tighter the Fed is for longer, the more that sends a signal of slower growth and less inflation down the road. So our base case is we get 3 to 4 rate cuts, 25 basis points each between now and year end, and that yield curve kind of steepens a bit from here with short rates coming down more than long rates. But if the Fed drags its feet, then it could go the other way and we'd see more inversion of the yield curve.
Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thanks so much for taking the time here today. Appreciate it.
Thank you.